Imagine waking up, you're looking through your investments, and you're seeing a sea of red. Sound familiar, right? That anxiety creeping in. What do you do now? That panic button. So tempting to press that panic button. Because you followed all the rules, you thought that you were diversified, and yet you are now looking at a massive loss. How can you get it all back? Is there a silver lining to all of this? And more importantly, how do you make sure you don't lose more? Welcome back to the Money Talks podcast. I'm Andrea Heng, your host. Whether it's a property play gone wrong, or a sure win stock that tanked, or a portfolio that just didn't hold up to market volatility, financial setbacks can happen to the best of us. But the path to recovery is often more emotional than it is logical, maybe even financial. Joining me today to navigate this is Grace Tay, Associate Director at Finexis Advisory. Grace, good to have you in the hot seat today.
It's great to be here.
So, I've painted that scenario, right? Have you ever encountered this feeling before where you've opened up your portfolio, dashboard on your device? You're seeing a sea of red. I mean, what's the first emotion or what's the first thing that runs through your mind when you see that? Like, oh my God.
I think everyone at some point in their investment journey would have encountered something like that. And I think the important thing to understand is that losses are part and parcel of investing because the market moves in cycles. Yeah, personally, my own loss experience, like with many people, came during COVID. So I also started my investment journey around that time, just slightly before COVID. And if you recall, just before COVID, the China markets were actually doing really well. Yeah, there were a lot of popular names, Alibaba, your tech names. Yeah, so when I got into investing, I started learning how to pick stocks. So it was a ground up kind of approach. Yeah, so I did my own research and I bought a couple of holdings in the China market. And of course, when COVID hit, China was the biggest loss, one of the biggest losers from COVID. So I recall opening my portfolio and seeing like a 40% loss. And it was literally, as you said, all red across the screen. Yeah. And my first thought was, okay.
Take a deep breath.
Yeah. To be honest, I wasn't too panicky about it because I understood what I was investing in. I did proper research. Yeah, and I had high conviction behind these holdings.
Right.
Yeah, and of course it was scary. There was a moment of, did I make the wrong decision? Yeah, but I didn't panic. Thankfully, I didn't do anything out of emotions.
Yeah, I think that's the right attitude to have. Don't have that knee-jerk reaction. I think people tend to forget to just really take a moment, sit back and take it all in before jumping into the next decision.
Yes, I do think that there is a lot of noise around us. And this often happens because a lot of times people don't have a proper strategy or a well thought through strategy for how do they want to invest, and therefore when things don't go according to plan, they don't actually know what to expect or what to do next. Of course, ideally is not to respond in a flight or fight manner, but oftentimes that is one of the most common things that people do. Right?
The survival mechanism kicks in.
Correct. It's that overreaction, and it can come in two extremes. So either someone just panics and exits the market entirely without first understanding what caused the loss, because the truth is losses, like I said, are common. Not every loss is a cause for concern. Much less panic.
Correct. Not every loss is a huge one, right?
Correct. Or it may just be part and parcel.
It's just part of the trajectory. Like there's no straight line. I mean, life would be quite boring lah. Let's face it. So you personally have seen cases where people lose 2/3 of their wealth. That's a lot. 2/3 of their wealth, even when they thought they had already been doing the right thing, they were on track, they've done their research, they diversified their portfolio, they've done the math. How does this still happen then?
It is very devastating to be in that position because if I recall correctly, this was a retiree. He would have been looking to preserve his wealth. So to have 2/3 of it wiped out, it's highly traumatic.
It's horrifying, yeah.
So I think what was prescribed to him then, and what people often turn to as the golden rule in investing, right, which is to diversify. Why the question is, why did diversification still lead to a loss?
Correct.
Yeah. So I think it's important to understand the principle of diversification.
Okay.
So how that's being done, it's to reduce the overall volatility of the portfolio.
Correct.
So that you reduce your maximum expected drawdown. Yeah, but there is proper diversification, and there is this other term that we call diversification.
Oh no. Okay.
Yeah, where the act of adding more things to a portfolio to technically spread your risk actually ends up adding more risk. Yeah, so you can think of the simple analogy as spreading your eggs across many different baskets, right? So the purpose of that would be so that if one basket drops, the rest of my eggs are still protected.
I see.
Yeah. However, that presumes that the baskets, the integrity of the baskets are intact.
That's right.
Yeah. But if you spread your eggs across many different baskets with holes, doing that actually increases the chances of broken eggs and not safety.
Yeah.
And that was what happened in that case. Yeah.
Okay, I understand totally what you mean by the integrity of those baskets. I think people often conflate diversification and confuse it with, it must mean I must have many, many things. But it can be just a number of things, maybe 5, and you are spreading how much per basket each basket deserves, or how much each basket should have that is less risk according to your risk appetite, right?
Exactly right. Yeah. So it comes down to what's the objective of diversification. Yeah. There's many different ways to diversify. The question is, what is the purpose of it? And it all goes back to 3 things, the 3 main pillars, I think, before someone approaches investing, which is what is your investment goal, what is your risk tolerance, and what is your time horizon.
Yeah, I think those are the 3 golden rules that we always talk about here on the Money Talks podcast as well. So what are some of the common mistakes then that some people have made when they have hit that financial rock bottom?
I would say 3 common pitfalls. The first we talked about as well, which is that overreaction. Reacting out of emotion. So either panic selling, or the other extreme would be to revenge invest.
Yeah, revenge invest is a good one.
Yeah, it's like revenge travel. Yeah, you've been deprived, and then you're trying to win it all back, right? In the space of investing, and that is not desirable because it's like the chasing losses effect in gambling.
Right.
Yeah, which often leads to financial ruin. So that's one of the biggest pitfalls that I see. The second is holding on to losses for too long, underperforming positions.
So how do you know it's too long? How do you know you're holding on to a loss for too long?
Okay, so I think too long would be any amount of time that you continue to hold on to an underperforming asset once you know that there are better opportunities out there, or better allocations that are more in line with your objectives. Yeah. So the reason that people hold on for too long, usually there are 2 reasons. The first is either a refusal to review what went wrong. Yeah. So they're like burying their head in the sand because it's too painful.
So denial.
Correct. Yeah. And the second would be just simply hoping that it would rebound without really understanding what's the probability of that rebound.
Yeah.
Yeah.
And I think there might be a third group of people who hold on to losses. They just are convicted behind a particular asset or a particular company or a particular stock because they're just personal fans of the brand. But I think if you are in that state or frame of mind, then you must be able to stomach the loss, right?
Correct, yeah. And I have a client who's exactly in this position.
Yeah.
So when he first came to me, he had a single stock holding.
Okay.
I won't say what it was, but he put his entire life savings of more than $1 million into this one stock.
Wow.
Yeah. So through COVID, it actually went up to 3 times. So more than 3 million.
Fair, right.
And of course, he held on to it because he was hoping it would continue to go up. But unfortunately, it came down. It came crashing quite badly. So when he came to me, it was at 800 plus.
Ooh.
Yeah, 800 plus K. Yeah, sorry, not 800 plus dollars. That would have been devastating.
Yeah, that would have been another level of devastation.
Yes.
But right, okay, so he's all right now. He's recovered some.
Yes. So he came to me because he felt that this could not continue. I mean, he still had a high conviction for the company, and I think that there is basis to that. I mean, I do think it's a good company. But at the same time, his purpose was also to grow wealth intentionally, or he had that as a priority, right? To retire in 20 years. So thankfully for him, he didn't panic because he still believed in the company. So what we did was we just clearly separated his investments into two buckets, the core versus satellite portfolio, which I'm sure has been much talked about on this podcast as well. Yeah. So that particular stock then became his satellite portfolio, money he could afford to lose.
Yes.
Yeah, and his other more intentional wealth building approaches would be we set up a separate core portfolio, properly diversified with a set of rules and parameters in place in terms of what do we allocate to and how do we rebalance.
Okay, so some people's first instinct I wanted to talk about that you brought up also is that revenge trading, trying to make it all back in one big risky move. I'm just curious, how often does it happen?
So it's a good question, and I think in reality, while I do think that does happen. In reality, I think most people actually don't do that.
Yeah.
Yeah.
It's too much hassle. It's too much stress.
Yes, it's too much stress.
Yeah.
And there's also this thing that has been studied. It's called loss aversion. Yeah. And oftentimes after a major loss, there is heightened loss aversion. So what this simply means is that studies have shown that we react to a loss twice as strongly versus a gain. Yeah. So oftentimes after a major loss, people tend to become overly conservative. Yeah. Instead of going out and taking even more risk.
That's right.
Yeah. So instead of moving to riskier positions, they actually end up perhaps sitting in cash.
Okay.
Which is also not ideal. Yeah. But in practice, to your question, I think that rarely happens. People who go out and spend even more money trying to make back that in investing.
I think that's also too much of a gamble for some people to take, especially when it's your hard-earned money, right?
Correct.
All right. So I've made a loss on my portfolio. What's the first thing I should do?
Okay, so I think the first thing that you should do is firstly stay calm. Yeah. And maybe take some time away from your portfolio to cool down.
Okay.
Yeah. Once you're in a bit better headspace, then I would say I use a 3 R's framework.
Okay.
Yeah. So the 3 R's are reframe, reset, and then re-enter with gradually with guardrails.
Okay.
Yeah. So reframing, first step would be to see the loss as a lesson rather than as a threat or as anything final. Yeah. So what that then means is diagnosing the problem, understanding what actually went wrong. It could be over concentration, it could be a matter of entry-exit timing, or simply sheer bad luck.
Yeah, just trying to find out why
what is
it
the cause
happened,
of it.
right?
Correct.
Okay.
Yeah. So that we can reset better. Yeah. So in resetting, again, the 3 big pillars of investing: what is your investment goal? What's that risk tolerance? What's your time horizon? Yeah. So that you can build a portfolio that's more in line with these 3 pillars. Yeah. And for my clients, I use a set of investment principles that helps to inform how do we build a portfolio that's in line with these 3 pillars. Yeah. And then finally, to re-enter gradually. Yeah, so if let's say you have monthly surplus that you want to put into the market, you can start with a smaller amount. Yeah. Or if you have a big lump sum, maybe you panicked and sold everything and now you're sitting in cash.
Yeah.
Right? And you want to re-enter.
Yes.
Instead of going in at one shot, spread it out over a few months. Yeah. So that any drops doesn't trigger a panic attack.
Yeah, I was about to say it actually sort of mitigates or at least spreads out the panic feeling that you might get whenever you see market movements, right? You're sort of you're sort of mitigating that loss aversion that you were talking about, right?
100%, yeah. Because you have not lost everything. You still
Exactly.
have some gunpowder on the side.
Precisely. So once you have sort of restabilized, you've done the 3 R's, you've re-entered the market, you have got a good hold on the ground, your feet are a bit more firm on the ground once you've re-entered, you know what went wrong. When you're doing that reframing with your clients, how do you know what the reason is? How do you identify, was that reason just bad luck, or is it almost always fundamentals, something went wrong in the strategy?
That's a very good question. And I think I'll answer that question with 2 client case studies, which I think can help to bring out different reasons for losses. The first would be the client who invested in that single stock. So for that client, the reason for the loss is over concentration in a single stock. If we look at it as the reason for his overall portfolio drop.
That's right.
But
because his entire portfolio was just that one stock.
Correct. Yeah. So I think a loss cannot be understanding the reason cannot be separate from what is your actual objective for investing. What is your goal? Yeah, we need to understand the loss in light of that. Yeah. So for this client, his goal was initially, I think his goal was really just high conviction, experimenting. He wasn't really thinking so much about building wealth intentionally and strategically.
Right. He was just saying, I like this stock. I'm just going to put my money there and not think about it.
Correct. Yeah, exactly. So the loss wasn't too much of a concern. It was just that now his priorities have changed, and we just want to be more intentional in building a portfolio that can withstand drawdowns. Yeah. So that was for this client. There wasn't anything fundamentally wrong with the stock. Yeah. Just maybe misalignment in priorities. Yeah. For another client that I worked with, when she came to me, she was actually intending to retire in 2 to 3 years. Yeah. So
that's not a very long runway.
Correct. Yeah. Thankfully for her, she had quite a bit of assets. But even within those assets, there were several holdings that were down 40 to 60%.
Wow.
Yeah. And
how did she take that?
Thankfully, it was 15% of her portfolio.
Okay.
Yeah. So it wasn't massive, but it wasn't insignificant either.
Of course.
Yeah. So she wanted to understand what went wrong.
Yes.
Yeah. And for her to understand a bit of context is that she's in her mid-50s. So someone of her generation typically has a lot of things in their portfolio, things that they have added over time on advice from different people. So there wasn't a coherent strategy. Yeah. So now that she was nearing retirement, she didn't have that certainty of how everything worked together to support her in retirement.
Right. So things were a bit all over the place, and she didn't have a unified strategy.
Correct. Got it. And then there was this few positions in a loss, and she didn't know whether the rest could support or what would happen. Would she experience another 40 to 60% in the future?
Fair question, yeah.
Yeah. So we did that 3 Rs, diagnosed what was the reason for those losses, and we found out that it was actually because those assets were not aligned with her risk profile. So she's pretty similar to the retiree. She's looking to preserve wealth. She still believes in investing. Yeah. So she is still keen to remain invested with a decent return of maybe say 4 to 5%. Yeah. But those assets, they were taking on a lot higher risk for higher returns in the realm of 8 to 10%. Yeah. And not only was it not aligned, it was also too concentrated. Yeah. So in a single country, in a single sector, in a single variant of that.
Wow.
Asset class.
Well, talk about concentration.
Yes.
It doesn't get more concentrated than that.
Yeah.
So when that happens, do you draw down from those policies, those assets, and then reallocate the funds? Is that the solution here?
Yeah, so different client situations, the solutions would be different for her because she didn't have that much more time to her goals.
Yeah, correct.
Yeah, so and fundamentally those assets were not aligned with what she was trying to achieve. Yeah, so the best solution would be to exit entirely. Yeah, and move into better opportunities, because staying in there would be akin to holding on to a lost position when there are better opportunities, more aligned opportunities.
Which is what you were talking about earlier, right? About how long to hang on to it when once you realize that you've made a loss, right?
Correct.
Okay, it's all tying together now. So, talk us through further how you would advise someone to regain what they've lost.
That's a great question. And again, every client situation is different.
Sure, yeah.
If we are talking about someone with maybe more than 2 to 3 years of runway, I would say that it's a perspective on the loss, right? So again, rather than see it as any judgment call or anything that is final, take it as a lesson. So it's just like a farmer who plants crops, right?
Yeah.
So his harvest may get destroyed by a freak storm, not unsurprising in today's climate. But that doesn't mean that he cannot replant. Right, so long as he has the willingness, the ability to plant, he can always plant again. And he can, and perhaps with more wisdom this time. Right, so it's the same thing with investing.
Right?
Correct. Yeah. So it's the same with investments. So long as you still have that earning capacity, you can always start by just building up your emergency funds, building up your savings, and then gradually re-entering the market, and with certain guardrails, such as maybe having a trusted advisor that you can work with to set out a proper plan to investing this time.
I have a follow-up here. Did you ever have a client who just didn't want to be in the game anymore? because the loss was just too hard to take?
I have worked with a few clients who, when they first started working with me, they told me they didn't want to touch investments
Yeah.
because they have been burnt before. Yeah, and it's very normal. It's that loss aversion that we were
Sure.
talking about,
Yeah,
right?
yeah.
To be overly conservative so they don't experience any form of
Yeah.
loss.
But were they more
Yeah.
challenging to sort of coax and persuade almost?
Most of the time, I have found out that it's simply what's missing is that knowledge and understanding of investments. Yeah,
Okay.
and that clarity about what is actually happening in investing. How do you approach it? Yeah. So once I share a proper framework, principles, exactly how investment markets work, which is not difficult. You just need to have that clarity of how simplicity looks like, have a plan and follow through with that plan. And eventually, for all of the clients that I work with, eventually they went back into investing. Yeah, and the
Oh.
portfolios are doing well.
Okay,
Yeah.
that's
So,
great. That's very heartening to know, because I do know that people, are very once bitten, twice shy kind of people, and then they just go into something safe and steady. What's your take on that?
Well, I think firstly, we going back to first principles to understand what safe really means to us.
Yeah.
And I think to a lot of people, safe simply means not to lose money.
Yeah.
Right?
Yes.
Yeah. But how do we quantify loss? So if we put everything, we liquidate all of our assets and we leave it as cash in the bank. Is that necessarily safe? I would say no, because if inflation is 3%, you are actually you are actually 100% guaranteed to lose 3% on that
Yeah,
cash
because you're not
every year.
beating inflation, right?
Correct, exactly. Yeah. So it's that lens to what safety means. And then once you understand that actually everything carries risk,
Yeah.
then it's about what is an intentional approach to risk, right? What kind of risk do you want to embrace?
I think knowing what risk is in your life and how big that monster is helps you determine how brave you need to be, right? If I feel like, okay, this risk I can stomach, if it happens, I'm not going to bat an eyelid. But if you don't understand the risk at all, then any risk seems very huge and scary to you, right?
Exactly. Yeah. And I'd just like to add to that as well.
Sure.
I think it's important to have different buckets for your finances. Yeah. And it's important to have buffers in your financial plan. So what I mean by that is that we should always separate short-term essentials from our risk capital. So short-term essentials would be everything we need to use in that 1 year for basic needs, to pay our bills, housing, and all of that.
Yeah.
So once we have that buffer, then we can we have more room to play around with that risk capital without fearing that if anything goes wrong, that's going to have a immediate and adverse impact on my day-to-day life.
Okay. So it's really protecting that financial core in your day-to-day life, and then that then allows you some space to move around in case anything happens. Risk is something that needs to be thought of as an essential part of your portfolio building, not just a if, because there's no such thing as zero risk,
Exactly. And that's where diversification comes in. Yeah, strategic diversification so that you can manage the risk in line with your risk tolerance.
In your experience helping people recover their losses, what kind of timeline are we looking at to start a recovery? Not say, bring gains back to a level that was had before, but perhaps, to feel like, okay, I'm out of the red now.
Okay, I think in terms of re-establishing psychological safety, right, to what you mentioned about, I can feel a bit more relief, less burden. I think the first step is to ensure that the day-to-day is taken care of.
Sure.
Yeah, so if let's say initially there wasn't this segregation of essential needs and risk capital,
Okay.
then perhaps it is about taking 1 year to build back that buffer.
I see.
Yeah. Where it comes to recouping losses in an investment, like you rightly mentioned, it really depends on how great of a loss that was. If it's a 50% loss, you actually need 100% to get back to break even.
Correct. Yeah.
Yeah. And how many in assets give us 100% return?
Yeah.
And it probably takes at least 2-3 years at the fastest.
Yeah.
Yeah.
Okay.
But I think the key is also that you don't actually need to recoup a loss. You may not need to recoup a loss.
Yeah.
Yeah.
Just
So
bring back to baseline.
Correct. Or you may not actually even need that specific amount back. So like just take my client, for example, the one who had 15% of her positions in a loss position. For her, she actually didn't she could actually just discount that 15% altogether
Right.
and still be able to retire comfortably. In fact, after structuring her portfolio, because there were things that were not optimal and did not serve her in retirement. So after we did that restructuring, she was able to shorten that timeline to 1 year.
Oh, wow.
Yeah.
Okay.
And that was even without needing to recoup that 40 to 60%.
Right.
Yeah.
Yeah, that's the thing, right? Because you sit there looking at the amount you lose or you have lost, and all you can think about is, how do I make this money back? So you're saying it's not necessary to look at just that number in totality.
Correct.
Right.
Yeah. Because I think end of the day, right, investment is just a means to an end.
Mm-hmm.
So if you can get to the end without the necessary means of recouping the loss through an investment, then you are still fine.
Yeah.
And investment is how much you have in the portfolio is just a number. At the end of the day, we can't bring it with us.
Yeah.
Yeah. So long as we have enough to live the life that we want to live, we're comfortable, we can meet our investment goals. I think that's more than enough.
It should be so simple, but it is not easy.
Definitely.
Before we let you go, Grace, what is one rule of thumb that we should keep in mind if we're sitting on a loss and we feel like it's going to be impossible or nearly impossible to recover?
So I would simply apply the 3Rs framework. So again, it's reframing the loss, resetting, so that you can build your portfolio in a way that has the greatest possibility to get you to your goals, and then to re-enter with guardrails. So it's every loss is multifaceted. And the most important thing is really to understand, which is the diagnostic part. And then finding a solution, because then you can move forward. And the last thing that I just wanted to expand a little bit on, which I haven't mentioned previously, is about the guardrails part.
Yes.
So yes, it's about re-entry, but it's also important to have certain safety nets in place. So some of this could be perhaps if you are prone to reacting on emotion, it is to maybe automate your investment, so it bypasses emotions, right? Or another way could be work with a trusted investment buddy or a trusted advisor who can stand between you and an emotional decision, or just give you a different perspective on things.
I think we have to appreciate that it is a process. As much as making gains and making the right investments is a process, allocating your funds correctly and strategically is a process. Processing the loss is also something that we have to go through, right? The same emotional journey. I think that's the one thing that I'm taking away from you, Grace, today. So thank you so much for helping us understand and learn to process losses, because they are part and parcel of investment and they're part and parcel of life. We need to know how to manage the difficult moments in life, including in investing. So thank you so much for
Thank you. It's my pleasure.
making us comfortable with mistakes.
Thank you. Thanks, Andrea.
And thank you to the Money Talks community for tuning in as always. One question that I have for you now: what was your biggest financial oops moment? And what was the lesson that stuck with you from that experience? You know mine already from years before. And I'll repeat it again. Mine was going into too much credit card debt and then using all sorts of other means to pay it back. Oh, that was such a difficult and dark time for me. But I got out of it. So can you. A loss is not forever. That's the takeaway that I have from Grace today. Let us know, by the way, what your answer is by commenting wherever you're listening to us from. And you can also write to us directly, cnapodcasts@mediacorp.com.sg. I'm Andrea Heng, signing off for the Money Talks podcast.